So despite a slowdown in global growth in 2019, global markets have had quite a strong year. We've most equity markets, including the Australian market, up about 20%. The Australian bond market is up close to double digits, and the year ends very different to where it started. At the start of the year we had the Fed raising rates, they've turned to cutting rates. The RBA was talking about the next move in rates being up, and they started cutting rates and have even openly started talking about QE. So for 2020 we have a sluggish outlook for global growth, 2.5%. That will be driven by a mild recovery in industrial production. We think the de-escalation of trade tensions between China and the US should reignite some capital spending in the US and China, and hopefully Brexit will be put to bed. For Australia, we remain reasonably optimistic. We see an increase in GDP, a pickup delivered partly by infrastructure investment. We note the recent announcement of tax policy by the Treasurer talking about tax benefits for those who undertake large infrastructure projects. We also think the RBA will continue with its easing policy, although we're uncertain what that will actually look like. For the US, they're faced with some uncertainty around the US election. We have inflation that we think may pick up a little bit there, but hopefully only temporarily. And the Fed's on hold. So we see the US growth coming in at 1.8%. We see Europe operating at a stall speed with 1% growth. And China likely to be a little bit slower this year than, or next year, sorry, rather than this year, coming in at 5.9%. So overall, amongst the asset classes, that leaves us with the Aussie government bond market, where we think that will likely range trade over the year as the economy looks for an impetus to drive it. Ultimately, though, we see it will eke out a small positive return in the Australian bond market. For equities, we think there's limited earnings growth that should translate into single-digit returns for equity markets. The key risks there remain uncertainty around the trade talks, the potential for upheaval in Hong Kong and the Middle East, as well as inflation. If it comes in higher than anticipated, particularly in the US, that could lead the Fed to having to make some tightening of monetary policy. In terms of our view of the asset classes, we have a preference of equities over bonds. Regionally, we like the US. We think they're likely to be the benefactors of the better growth prospects. They also have a large technology sector, and technology is likely to continue to benefit from the economic activity, as well as enjoying the benefits of the trends in digitalisation, automation and artificial intelligence. We also like emerging market equities. We think they are likely to make up some of the relative underperformance over the last 2 years that will assist markets. Cash is our least preferred asset class to be invested in, and given our expectation of lower returns for both equities and bonds, alternates look particularly interesting. Hedge funds is a very wide universe of solutions and strategies. However, those that can deliver lowly correlated returns can really assist in the portfolio stability. We like direct property, and in particular those with industrial and well-leased properties. We are wary, though, of the impact of digital retail and disruption, so that needs to be considered. And then within portfolios, private equity we think has a place, and there's somewhere that is potentially underinvested by a lot of private investors. You need to be quite judicious in your selection of managers, though, as we've seen a number of high-profile opportunities where private equity is trying to bring some investments to the public markets and they haven't gone so well. So important to associate with some top-tier portfolio managers.